Today, we are talking about Bitcoin, what might be behind its latest slide, what Michael Saylor is doing about it, and what you, as a high income earner, can do about it too. This is The Will Whiten Show. So first off, if you've been enjoying the show, please hit the like button, subscribe. It really helps for the YouTube algorithm. So on to the big story about Bitcoin. So if you've noticed, there's been a large slide in Bitcoin prices. It touched to a low of, I believe, around $83,000 per Bitcoin. It spiked back up the last couple days, and it now sits around $93,000 per Bitcoin. Now, for those of you that remember, the highs were well above 100,000. So this represents a good, at least 30% decline from the peak of where Bitcoin was. And what's behind this? And a lot of this can be, or what's referred to as a risk-off attitude. There's risk off. There's people starting to step back from riskier investments. And there could be a variety of reasons for that. But especially when there is uncertainty in the economy, then that can cause people to look for safer assets. So if you think about all sorts of assets and you kind of arrange them by their perceived level of risk. So you can start with what is perceived to be the safest. It could be cash. Then if you start to move to investments, you can talk about bonds. As you work your way up, you could talk about stocks, and then you could talk about alternative investments, which could include commodities, or particularly leveraged investments, or private equity. And then on top of that, you can then throw in things like cryptocurrency. And so that's kind of, if you're just looking at the broad base of asset classes, what could be perceived as low risk all the way up to higher risk. And so when there's times of uncertainty, people will start from the higher risk items, investors, and start to pull money out of those and start to reallocate that money into safer assets. So we've also seen a slide in AI stocks, tech stocks, because those are perceived to have a lot of risk. There's been a lot of talk about where this AI bubble might be going. Are we fully in a bubble? Is it about to pop, or are we just kind of in this kind of stagnated in kind of this stagnation? And is there going to be some factor that really emerges to then show us, oh yes, we've been way overvalued for too long and there's going to be a large correction? Or, hey, no, there's this new breakthrough and there's actually a lot more room for AI stocks to run. And so there's this wait and see approach happening. And that obviously applies to Bitcoin and tech stocks. And I'd say this, when it comes to my own investments, when I look at all different asset classes, I don't typically look at cash as safe. So it is, and I have to ask myself, when we're looking for something safe, what are we looking for safety from? What are we running away from? And so a lot of people may say, well, just straight downside, right? We don't want, significant downside. So then they may be trying to guess and time the market and suspect that there could be significant downside in Bitcoin, which there obviously has been. So that kind of becomes a self-fulfilling prophecy, right? So if everyone's piled into Bitcoin and says, well, the economy is uncertain, there might be downside, that there might be price drops. Well, let's kind of get out of these risky investments. Well, then that cascades into price drops. So you could be trying to escape some significant downside. But I always keep in mind that cash always has a downside, right? So the Federal Reserve tries to target an average level of 2% inflation. And so that means that prices will gradually go up over time, and therefore your dollar will become less and less valuable over time. So holding cash is a guaranteed loss. Now, with the exception of, say, the past 5 years, that loss has usually been rather small. And people are willing to say, okay, I'll take the loss in terms of my cash, right? This is not a total dollar amount loss, right? If you move all your investments into cash and you say you have $100,000 of cash, you don't then have, $99,000 in cash after a year. It's the inflation impact that makes your $100,000 not be able to buy what it used to buy the year prior. So you don't see a number drop, but you do see a value drop, if that makes sense. And so but there's a guaranteed value drop that will always happen in cash and will always be steady. But many folks will say, well, I'll rather take that guaranteed steady drop over the potential drop in Bitcoin, like a downside of 30%. And so obviously that, minus 2% sounds a lot better than minus 30%. But at the same time, you have people like Michael Saylor. He founded and runs a company called MicroStrategy. They recently changed their name to just Strategy. He's known for using the treasury department of his company to invest substantially in Bitcoin to the tune of, I believe their Bitcoin is worth about $56 billion. And many people, if they don't want to invest, say, directly in Bitcoin or buy Bitcoin, some people will just buy shares in Strategy as a proxy for Bitcoin. Right. And they recently announced a stock sale, and they've decided to build what they're calling a US dollar reserve for their treasury department. And they want this reserve to be able to cover dividends for 2 years. I think in the press release, he said that he's able to cover about 21 months of payments now of dividend payments. And so they're targeting 24 months. And so this is a shift in how he operates, right? He's been all Bitcoin for a long time. He was interviewed, I think this is now 2 or 3 years ago, on the Patrick Bet-David podcast, and he talked extensively about his case for Bitcoin, and he compared it a lot to real estate, in which he talked about the Hamptons and Palm Beach being the true only two, very well isolated real estate markets, because at least from what he's seen, no matter what, there is a very limited supply of homes, and there is almost no limitation to the demand of the wealthy people that can live there and that want to live there, right? And so that's getting back down to the very basic dynamics of what could give something value, which is low supply and high demand. And he referenced Bitcoin as having a limited supply, unlike many other cryptocurrencies, and a constant demand. Now, he's also demonstrating excessive demand, and I believe he holds 3% of all Bitcoin. But that's his case. He says there's a finite supply, and so I will grab as much as I can. And I believe they also lend this out. But so he's been all Bitcoin, or I should say on the Bitcoin train for a long time. But there's been this obvious shift in strategy at Strategy for over the past week to try and deal with some of the choppiness associated with being so heavily bought into Bitcoin. And that's exactly the reasoning that he shared for doing that. It's to bring stability to the company such that they can continue to make, for example, dividend payments. So I think it's reasonable. It makes sense. It's hard to pay dividends if you don't know if your cash reserves, which in this case are Bitcoin. So if your Bitcoin reserves are going to be up or down, 30 or 40%. So that obviously makes it a bit more difficult to give investors comfort and make sure that they know that you can pay what you owe them. So that's what's gone on there. And again, back to our personal investments, I'd say that the volatility, or I'd say that the big drops don't necessarily scare me, because I'm always looking toward the long term. And if we reference Michael Saylor again, he's actually added to his Bitcoin position as prices have come down. And I take the same approach to the ETFs that I invest in, and I try to buy more when things are on sale. So I always try to constantly be buying, But when things seem to be going down a bit, I try and buy a little bit more. Warren Buffett has a famous quote: if you love hamburgers and hamburgers are $5, and then the next day the store announces, or the Hamburger Shack announces that hamburgers are now only $2.50. He's like, I would jump for joy. I'd go buy 2 hamburgers for the $5 instead of just the 1 hamburger for $5 that I used to buy. And so it's a mental shift that many people must make if they want to be successful in investing in the long term, because it's very instinctual to own something at, say, $100 and see it go to 80 and say, oh no, panic and sell, right? And just take a 20% loss on the chin, when really the mental shift should be, no, look, what I thought was valuable at $100 and what I thought was worthwhile buying at $100 should be even more worthwhile buying at $80, assuming the underlying fundamentals of the investment, whether it be some sort of real estate, property or a stock, a company, if the underlying fundamentals haven't really changed and you still believe in the success of it, well, then great. The thing that you thought was worth more than $100 and you bought it $100 is now at $80. And if you still think it's worth well above $100, well, then you'd love to buy it at $80 also. So that's a shift that must happen. And it's one that I made early on in investing and that I always try and stick to. So when things are going down, I try and smile and look for that opportunity to continue to buy more than I would have otherwise. So that's the story for today. I hope everyone had a very happy Thanksgiving last week, and I hope you have a good night.